You said at the start of the year, the biggest risk was upside risk. You were dead on. We rallied really, really hard. Can you tell me now just how balanced those risks are looking up and looking forward?
Well, look, I think, thanks for the props. I think where we are right now is an environment where the narrative has shifted from first half down, second half up, to first half up, second half down. And what I think is interesting is I still don't think investors are positioned for that. So I would argue that the pain trade might continue to be up. Now, one thing that's making me think that the positioning has actually shifted is if you look at some of the earnings data, we've actually seen pretty strong resilience from corporates, pretty strong resilience from consumers in terms of very strong spending data coming in our credit card data, which is real time, showing that January sales were actually a huge surprise to the upside. And then when you look at corporates, I mean, they've been very nimble in terms of cutting costs. So what we're watching is sales growth. I think that's really the linchpin of whether we get a soft landing, a hard landing, or as some of the real optimists are arguing for, no landing in the economy. And so far so good. But I think that as we've seen time and time again, typically the next leg down is just demand destruction. So we're watching for that. And, again, we called our report this morning, never underestimate the corporate sector or the U.S. consumer, because the U.S. consumer has what seems like insatiable appetite for goods. And corporates have this ability to navigate margin pressure quite ably, as we've seen even in the fourth quarter where we had everything working against margins. We had massive cost pressure, a little bit of a drop in demand, and fourth quarter margins are only missing by about 20 basis points. So, well done, corporate America.
Savita, let's stay focused on the shorter-term tactical call, the potential for more upside risk. You weren't surprised by the rally. Have you been surprised by the composition, the leadership of that rally? There was this phrase that you and the team have used, new economy gain, pain, old economy gain. So that's new economy pain, old economy gain. Have you been surprised by just how much tech has led?
Well, sort of. I mean, I guess what makes sense to me is that a lot of this is really just a short covering rally. So if you look at the companies with the highest short interest actually had like a 2 standard deviation upside move in terms of just kind of hedge funds and investors closing shorts in areas that were mostly tech heavy. So the losers of last year, i.e., long duration tech stocks, actually were the winners in January. From here, I think what could be interesting is to watch a transition from the laggards of last year to some of these, what I would call medium duration companies, cyclicals with a little bit of a dividend growth angle. And that's an area that I still think is under-owned, is poised to perform pretty well in an environment where investors are shifting from looking for returns from just price appreciation to total return. A lot of these cyclical companies are still trading at attractive valuations. Look at oil markets. I mean, we've seen a big move higher in oil, and I think energy companies have finally gotten supply discipline, capital discipline. We're hearing it from all of the management teams. Share buybacks are more important than production. So I think this is a really interesting time to stick with real economy focused companies that could benefit from, potential pickup in CapEx.
Bear market is over. Chris Harvey of Wells Fargo this morning. That's his line. Do you agree?
Look, I think that we're going to be in a muddle. I mean, I think that for the S&P 500, we could remain in this bear market for a while because we're in the process of right-sizing tech and everything else kind of getting bigger in the benchmarks. And that's not going to be a great environment for the S&P 500. But for the S&P 450, ex-Nifty 50, I think we're out of a bear market and things are only going to get better.